interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Welcome to the Raw Selection Private Equity Podcast, interviewing the leading private equity executives on unlocking their secrets to success. Joining us today is Krista Morgan, general partner at Stage and founder of multiple companies. Welcome, and thank you very much for sharing your insights into the industry today, Krista.
No problem. Really happy to be here.
As our normal starting procedure, if you can give us a 60 to 90 second breakdown of you, please.
Sure. So I'm Canadian and I grew up in Montreal. I went to McGill. I have a degree in economics and political science. I left school. I worked at a small custom motorcycle frame manufacturer, which is a lot of fun. And then I moved to London. So I moved to London for 6 years. I worked in advertising, digital marketing. So for small agencies and then a pretty large agency. Loved it, had a great time. And then I came up with this idea in about 2011 to put crowdfunding and invoice financing together. And I talked to my dad about it, my dad who lived in Denver. And I decided this would be a really good idea to start this company. And so I moved to Denver, Colorado. We started this company called P2BI. We did accounts receivable and inventory finance in a pretty unique way. And then I really it didn't end the way that I hoped it would, unfortunately. And after I soft landed the company and through this, what was a very traumatic process, ended up meeting my partner, Dan, now one of my partners. And he said, you know, Krista, like it or not, you have a real gift for turnarounds. You should come and join me at Stage and be a partner. And that is how I ended up here.
Okay, interesting background. Had you kind of dabbled in the private equity venture type world previously, or was it just literally because of this meeting with Dan?
No, I had not. I had raised money. So I've been running a fintech company. I'd been in the venture world, you know, I knew, but I really only knew it as a founder, which as I've learned is very different to, you know, how you approach it as an investor. So it's been a learning experience. That said, you know, I do think what I learned as a founder has given me, you know, is sort of contributing to why I'm good at what I do today.
Okay. Impressive. So I know your firm's kind of thesis is founded on this, and I want to get into that, but what's kind of one of the mistakes that you see either private equity, venture capital firms making, and what actions would you suggest to correct them?
I don't know about, I haven't been in the industry long enough to know what mistakes people are making. I guess what I would tell you I see as I look at deals is we really take the approach that it's hard to find value if you're not willing to look past the surface. And so we really pride ourselves on being able to do that. And it's something that I think differentiates us, because right now it is hard to find value in today's world. And I think that's how you do it. I think there's so much deal flow that people find it easy to just discard things because they're a bit messy. And actually there's so much to be, you know, I think so much just really profit and value to be gained by looking into it.
Okay, makes sense. And I know your approach to kind of venture, or as you put it, kind of early stage PE investing kind of challenges that norm of venture capital investing. Why has Stage taken that kind of approach to the market?
So I wouldn't call it a challenge to venture, right? I think there's room for venture. I think you've got companies that are going to go down this, you know, unicorn, now decacorn path. They need, right? They need a ton of capital. This makes a lot of sense for them. What I challenge is the idea that we have this thesis that if for some reason you are not getting more venture funding, that means that there is something inherently wrong with your company. And what we believe is that, when we look at the market, we see an average Series A company has received $25 million of investment. Like, when you really think about how much money $25 million is, and at every stage, right, at every round, there is a 50% drop off. So from Series A to B, B to C. So you're talking about 50% of the companies that got money are dropping out of the market. Our view is, look, why are we assuming they're bad just because venture doesn't want them? Venture has a very specific thesis. So actually, if we can go in, but because no one values those companies, we can buy those venture dollars. We can basically leverage that investment that's been made at a pretty significant discount. And that's where the opportunity is. Now, there's still early stage companies, which means there's still a lot of work to be done. It's not just go in with your spreadsheet, optimize the margin, and kind of makes it like these are companies that still require real operational strategy to figure out how are they going to get to market properly, how are they going to grow. So I see us in this, what I like about it is I think we're taking this private equity approach, but we still get the upside of venture because we're coming in at this very early stage, and there's still a ton of upside to be gained if the company can grow.
That makes sense. And not revealing too much secret sauce here, but are you guys seeing quite a huge amount of kind of what I regard as, if you want to put it in the world of failed venture as they go through the series rounds? And if so, how are you kind of understanding how do you look at what's going to be a good business and equally one that you don't want to run with?
Well, I think that's where, having been a founder really helps, right? When you go into an early stage company, I would say at our core, we're looking for product market fit. So what we want to know is there a real product? You don't want to go in and have to put another, we looked at this company that had taken $42 million and they didn't really have a product that worked. And we were like, well, this is going to require another $10 million just to get a working product. So we want a product that works. We want to see customers that are using this product, that have chosen this early stage product over, what were likely larger incumbents, and why did they choose it? And so where's the value in that? And then, really trying to figure out, is the core business model profitable? A lot of startups go into this, like, their cost of acquisition is higher than the lifetime value of their customers. This doesn't seem sensible to me. We don't invest in those businesses. So it's really, you're trying to find a company that really has potential, that can grow, but also is not going to require millions and millions of dollars just to get market share, that they have something that you can grow a little more organically, grow more profitably. And then, a tech company, if you can get a tech company to 5 to 10 million of recurring revenue, and they're not burning cash, that is all of a sudden a very valuable asset, especially in the world of add-on, right? When people are looking at roll-ups and add-ons, that becomes hugely attractive. And very few people are building companies with that profile because they're all going into venture and not thinking about profitability until the later stage.
Okay, it seems like quite a unique model, but a simplistic approach to ventures come under a lot of flack because it does have a huge burn rate, and if you've got 10 companies, 8 will probably fail. 1 will be the unicorn, which will pay for all the rest. And then you'll get 1 that'll just do a straight return on capital. I'm going to guess that your model obviously differs based on that model. Have you guys got a much better success rate because of the approach that you're taking? I'm sure you're not going to say no to that. But is that, significantly better? Are you keeping, losing a significantly less businesses on the success rate? Are you retaining all the companies that you're investing in?
Yeah, my partner Dan always says that venture is a business of home runs, and we are about singles and doubles with the occasional home run. So we do get companies in our portfolio we really can get an outsized return. We have one right now that's doing great, but we're not we're not looking for zeros. As I would tell you that's where, so I have a background of a lender. So I really don't like to lose money. I really like to protect principal. So we structure for downside protection. I mean, if you buy, so we buy, we might buy a $2 million revenue business for $500,000. So you're paying less than 1 times revenue, provided that company, there's some value in the tech. You can usually, that's probably not going to be a zero. It may not be your big winner, but we really look, we're trying to protect that principal risk on the buy.
And obviously with these businesses, they'll be in a, you mentioned that kind of turnaround background, and these businesses are, I say turnaround, they're not really established yet. So you're not turning anything around, you're kind of building from the ground up. I'm going to assume that you take quite a hands-on approach, and I kind of got that from the research I did on the firm. What are the challenges that you're seeing in these companies that are kind of recurring, that you guys have learned from, that you're supporting one portfolio company to the next portfolio, and you're like, I know you feel this is unique to the founder, this is what everyone goes through, and this is the kind of playbook? What are you kind of seeing from that perspective?
Yeah, honestly, the biggest thing is getting this whole company has been built to just solve problems with money. This is like this early stage. They've just been given a lot of money. This is how they do things. Like, this is not working, let's hire this person. This is not working, let's, buy this thing. And so the hardest thing in our playbook is we have to shift them from, hey, we are not going to hire in advance of revenue. Hey, we are not going to just write we're not just going to sign up for $100,000 a month of marketing before we know if it works. Like, so it's almost a cultural shift of, this is how we're going to do it. One of the companies in our portfolio, when we bought them, the year we bought them, they did $5 million in revenue. They lost $3 million. And the year after we owned them, they did $8 million of revenue and they made $1 million. And the company CEO, when I said to him, look, we're going to have to cut these people, we're going to have to restructure. And he was like, it'll never work. It'll never work, Krista. And now he's like, oh, it worked really great. And now they're growing again, right? It's a real success story. It's not always that, it's not always that drastic, but it is amazing how just changing your mindset, moving out of that. And I say this, having been a founder who was in the venture mindset and had to very quickly shift. And it is really difficult. So that culture piece is probably the biggest thing. And the rest of it is all, I mean, look, we do take over their back office. We have a studio. We centralize all the administrative and financial operations and sometimes the founders are like, we want to be in control of our own bank accounts. And we're like, no, so that's a cultural shift from them also, to not have control.
And I assume when you're taking over these businesses, you are keeping the existing management team in the most part. You're not just taking a product and then building a business. I'm assuming you're taking the whole lot and the people, or you're doing both?
Well, it's both. So we're control investors. We like to keep the founders.
Mm-hmm.
It is really hard. Sometimes a founder, like, they can't, in their mind, they're like, I've failed. I had this dream. I was going to be the next Uber and I'm not. So now I'm just, this isn't for me. But what's interesting, and I think the more we go about this, we have all these examples where, once you get out, if you're a founder and you've been given $25 million of venture capital money, you're sitting behind a preference stack, right? How you are going to make money, you're so diluted and you've got so much preference ahead of you. It's hard to actually make money. If someone offered you $30 million for your company, you'd have to say no, because you wouldn't make anything. And what we say to them is, look, this is a clean slate. We're restructuring out that preference. We've got full control of the cap table. We can afford to re-up you to 20, 30% of the company. Okay. And now we're going to support you. And now if we do give a $30, $40 million exit, like, you're walking away with real dollars, right? That you wouldn't have gotten before. So this has kind of probably been my passion project. Like, I think Dan, when I joined Dan, I said, I think we can figure out a way to get founders to be excited about this and just see this as an alternative path rather than a failure, mm-hmm. right? That they just didn't make it. We would love to be able to keep them, but it doesn't always work.
Okay, that sounds like an interesting model, and definitely I see where I was a bit confused when you were kind of on the looked at the firm. It's that kind of private equity approach, and it's basically the private equity approach in venture, and looking for proven or soon to be proven business models where they've got proof of concept, I suppose, and then making those investments and not going down what I regard as the cash burn model of just keep going through, keep doing series rounds and the celebration. I mean, I think it's Gary Vaynerchuk in the US who, speaks very derogatory about that kind of model and actually says to people, if you can actually make money and actually make profit, then that's a much stronger business model than trying to be, as you mentioned, the kind of next Uber.
100%.
But as you said, there's obviously a place for that because businesses probably like Uber probably would not exist, and other type unicorn organizations. It's just an alternative method of being able to grow a business through capital injection without having to focus on just the next round and just the next round. So yeah, really interesting. Excellent. Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. So obviously looking at the firm, you guys push yourselves as that kind of, from my perspective, dealing with venture capital, private equity firms all over Europe and North America. It's very rare to see women in senior positions. And I don't blame that on private equity or venture. There isn't enough women coming through and looking at the environment and going, I want to be in finance. I want to be in private equity. And whatever else. So, I'm not saying that private equity needs to sort itself out, although it does need to take some actions without getting on my soapbox there and defending. But it is, to come back to my point, it is rare to see, a majority female-led firm. For you guys, has that been by kind of coincidence or has that kind of been by design?
Well, I guess I will speak to the first thing is, so I came into finance with really no background in finance. I mean, I have a degree in economics, but I mainly studied the gold standard. So it's not like the really hardcore economics stuff. So I think when I was going to start this finance company, I had to learn everything, right? And I didn't come in from this world. And I think it's very intimidating. It's very intimidating to come in because you're like, oh, I don't understand the jargon. The first time I sat in a room with someone and they were talking about BIPs, and I was like, what the hell are BIPs? Like, what is going on? And so it just, I think, removing some of that and just, kind of I think there is a sort of barrier that's created in finance and, in private equity that doesn't necessarily need to be there. In terms of whether our firm was by design, Dan had been running stage on his own, doing direct investments for 10 years, had a good track record, had wanted to scale it, but, just, I think, never found the right person. And so when he and I got together, we worked really well. I think Dan, I think, wanted to support me. He didn't have to say, come and be an equal general partner, and he did. So I definitely think he advocated for me. And I think that was not necessarily because I'm a woman, but I think we just got along. And then when I brought Ingrid in, and then Ingrid and I have known each other for 10 years. We're both female founders. So, we'd been friends for a long time. We had talked about working together, and she just, when I was thinking, she left her job because we started this like right before COVID, right as COVID was starting. And, she took a package and I was just she was the first person she called. I was the first person she called, and she said, look, what are you doing? And I told her, and she was like, that sounds really fun. Do you want, can I join? And I said, yes, you should definitely join. So, it was kind of, I think part of it's network, right? Also, the more women we get into senior positions, the more their networks will just inevitably bring more women in. So Ingrid wouldn't have thought of herself as a private equity person either, but she was like, oh, so we're just going to buy companies and run them, and we already know how to do that. And I said, yeah. So, you kind of take the, all the, whatever, the wrapper off, right? At its core, that's what we're doing. like buying companies. We run them better.
Very simple. Yeah, I agree. We know, especially when we're hiring here and I'm trying to explain, and a lot of people that we speak to, they're either been in background in sales or in different areas of search and or recruitment. And they're like, I don't know what private equity is. I've Googled it and still don't know what private equity is. It's businesses that buy other businesses, grow them, and then sell them. In simplistic fashion, that is like anything in finance and business. We create a lot of words around things. We have a lot of different words for different things, and God knows how many different words there are for revenue. It creates that kind of allure of complexity when, in essence, the simplistic nature of what happens is simple. Obviously, when it comes down to running a business level and growing companies, that's definitely not simple, but bringing that experience in. So I'm pleased to hear that I'd say it's by coincidence. It's just by network and contacts and good people coming together, which is absolutely what we want to see. So, you've obviously, looking at your background, obviously with the previous businesses that you've run and founded, and you obviously won a lot of awards across that. And it's an area of mystery, I think, to a lot of people as to how people come around these, and there's a lot of how did you get that? Where did that come from? So, what do you kind of put your awards down to? How did they come about, and how did you kind of win so many across your career?
So I came up in marketing, and I care a lot about marketing and brand. And what I know is that if you invest in those things, it just helps your business, right? So I always knew that getting publicity and getting out there was a way of effectively getting free marketing for, my startup before this, and now the firm as we're trying to become established. And so I mean, look, a lot of it is just applying for stuff. I would always have a marketing person on staff. It would be an early hire that I would made, where most people wouldn't necessarily invest in that early. That was always something that I did. And so it's a lot of getting out and applying for things, and not just applying for things, but, getting in touch with the people that run those competitions and trying to get, because it's all a network, right? People if they like you, right? We're in a people business. People like you. They want to then, talk about you, have you on their very prestigious podcast. So it's so that was really, I mean, it's as simple as that. And then every award you win, then other people want to give you awards. So it really builds on it once you can get started. I will say something we never did. We never really paid for awards. It was always trying to I start with your local newspapers. The Denver Business Journal, for example, do a lot of awards. So if you're in Denver, you start there. So that kind of starts small, and then you sort of get up to being like bigger, more national forums.
Okay, and I'm assuming that obviously brings a lot of awareness, both for you personally, but also the business, and has been a bit of a snowball effect from brand awareness, and obviously therefore increases in revenue and new customers and everything from there, I suppose.
Correct. Like we've been doing this at Stage for 2 years, and people are like, oh, you guys are doing great. Like, they're like, you must already have like $1 billion under management. And you're like, because it matters, and it really adds up. So yeah, we invest in marketing, we invest in PR, and those people are great at that.
I think, and interesting you say about the marketing investment. I think there's too many firms. I admit it's definitely faster growing at venture level than it is at private equity level, because I just see a lot of things transition from VC to PE, which I think people would argue differently, but tends to happen first in venture if it's a new concept, and then eventually private equity will begin to pick that up. And I certainly see that marketing and that investment in PR is an area that a lot of firms are missing out on, because if we look at the three concepts, as far as I understand marketing, is that kind of know, like, trust basis. What firms are trying to do is trying to pick up portfolio companies immediately on first conversation, in essence, whereas they first need to know who you are, then they need to like you, and then they'll then potentially consider you. And it's not let's just go to an investment bank and knock on the door, have a conversation, and then we'll win the business. It's about building that kind of marketing and funnel. I hate the word funnel because everyone overuses it, but in essence, it's building that funnel. And it sounds like you've done that earlier in your career, obviously with your previous business, and it sounds like you're adopting that as well with Stage.
Great. Worked once. We're going to do it again.
Yeah, absolutely. Repeat. And no doubt that filters down into your portfolio companies and you use those toolkits to drive that as well. So interesting. One of my favorite questions on the podcast is what 3 attributes do you believe make a top performer? And I think that's going to be an interesting aspect from somebody who's obviously now as an investor, but also previously a founder. So what's your take on that?
Yeah, good question. So I definitely think operational expertise in whatever the areas you're going to be investing, having lived it just you cannot, is so hard to really know what's happening in a business unless you've been in a business, and you also know where people hide things and where things happen that you don't think to ask for in your diligence. It's because as startups, like if you're running an early stage company, for example, you are always like putting this face out to the world of like, pay attention to all this stuff here and pay attention to nothing this behind the curtain. So if you've worked in a startup, you know where that curtain is, you know how to find it. So I think that's critical for anyone, to really be a great investor. And then the next thing is, for me, I am always thinking about, so I believe in private equity a lot, we make our money on the buy. And so to really make your money on the buy, you really have to understand leverage. And you got to figure out as you're doing a deal, what can you give the other side that they really want that costs you nothing but gets you a lot of value? And so thinking through, for example, we do a lot of our deals in partnership with like a venture lender because they're trying to get principal on an asset where there's no real hard asset. The company needs to just keep going. And I'll be doing a deal and I'll say, look, we'll give you this price, but we'll get the deal done by December 31st. And I know the banks want to get the loans off their books by December 31st. That date has huge value for them. And so if I'm willing, and I can say, look, what I know is that means our team is going to be working over Christmas and they're going to be annoyed and I'm going to have to give them a bonus, but I'm going to get a really good deal. So like really thinking through in every situation, like the leverage and kind of having, I don't call it an instinct for it. I think it's just being curious and asking questions and really listening to what the other side wants and kind of doing that deal. So I think that's critical. And then the third thing sort of links to both of those, which is that this is a people business, that actually, if you are really good at seeing value, and if you are really in some ways too good at optimizing your leverage, like then you're an asshole and no one wants to do business with you. And I think remembering that, we don't do deals, like we do deals with people on the other side. And if you can't focus on finding balance and finding this Pareto optimal result where you didn't get everything you could have gotten, because if you get everything you could have gotten, no one's going to call you again, right? They just don't want to do business with you. And so this is what I love about this job is I think those 3 things are, great. I love learning about the businesses and seeing where we can find value and what's good about them. I love deal making. And then I really like people. And I try to do what I say I'm going to do. And I try not to change deals at the last minute. And I don't get everything because I want to be doing this for the rest of my career. And I want people to send me deals over and over again. And I want to be their first call, not their grudging last call because everyone else said no.
Yeah, I agree with that. And creating that kind of win-win scenario and that openness, candidness, and being like, look, this is the reason things are going to change. There's nothing I can do, or being, look, we can see this, we can see that, and just having that openness and being like, look, could we screw them over here? Probably could. Will we? No, we won't. We'll do the right thing, and we'll probably point out to them that this is probably what would have happened, but we want to protect you guys because of this, and etc. So yeah, definitely a good, certainly a very good trait to have. So having been on both sides of the table here, what do you love? And I'll coin it as private equity and venture capital, but what do you love about private equity and venture capital industry? And equally, what do you dislike about it?
In the end, I guess I'm still new to the industry, but what I really like about being an investor is I mean, I've been a founder, and when someone says yes, right? When someone looks at your business and says, yes, I'm going to help you, it's just this greatest feeling in the world. And so I love being on the other side of that. And it really pains me to say no, which we have to do more often than we say yes. But those moments when I do get to say yes, and I do get to say to someone like, look, let's like take your business and go down this new path. And it's wonderful. It's like the day after a deal closes, I feel great. And then it's Ingrid's problem. And then I do the next deal. So it's a really good, we're a really good team.
Over to the portfolio team.
That's right. And in terms of what I don't like about it, I mean, am I allowed to say lawyers? Sometimes the lawyers.
We've had a few lawyers on, so I'm sure they would argue differently. But what is it? Just to paint a picture of that, I think there's different scenarios. What is it you don't like about that process?
I mean, I think sometimes the legal, just, it's like, you're like, I just want to get this deal done. And then, the nitty gritty and all the terms and all the lawyers and all the back and forth, it really kind of makes that last mile of the deal feel like the longest mile of your life. And I think there are moments when it kind of takes the joy out of that, out of that piece. So it's like, I love the beginning of the negotiation. I love the minute it's closed, but some of that last a little bit in between. I know I do have very good lawyers who I like, but so I would hate for them to think that.
You'll be getting a few calls from a few lawyers telling you how good they are at the process post this, and maybe a few of your own lawyers getting a bit upset. But I think it's more the concept of all the bit back and forth and everything that needs to go on, rather than the more legal side, rather than the actual lawyer itself, by the sounds of things.
Yes, correct.
But it can be a real kind of back and forth from there. So, Krista, what are your kind of influences? What do you watch? What do you read? What do you listen to in order to kind of widen your knowledge and experiences?
Well, I have been getting into podcasts, so that has been a new thing. I mean, honestly, right now I'm trying to just, sort of listen to, it has been a lot of listening to interviews, just reading about some of the big firms and how they got started, and, and I'm sort of trying to go from being a founder to being, an asset manager. I had to kind of look up what is an asset manager when I first got started. So that's it. And then, I read the Wall Street Journal, I read the New York Times, because I figured if I end up somewhere in the middle of those two publications, I'm probably okay. And, and then I'm still very much into venture news, all the tech crunch. Like, I pay a lot of attention to what's happening in venture. What are the trends? Who's getting funded? Who's not getting funded? Where's all the data that's coming in there?
Sounds like some information certainly out there in the world. It's a difficult one to navigate. So unfortunately, you're going to get no doubt some contact, or some savvy lawyers will be reaching out. But if anybody does want to reach out post this podcast, how do they best reach out to you, Krista?
I mean, LinkedIn is the best. I'm on there and I'm pretty active. So, connect with me, and happy to have a conversation.
Perfect. We'll put that in the show notes for anybody who wants to reach out, unless you're a lawyer, which is very happy with the legal team. But I'm sure you'll try anyway. So, well, look, Krista, thank you very much for joining us. I really, really appreciate your insight and your different perspective from being a founder to now being, as you put it, an asset manager, or I would put it, an investor in companies, and taking that very different approach with private equity into venture. So really interesting. And thank you very much for sharing that.
Thanks for having me.
Perfect. And as always, thank you very much for everybody listening, for joining us. And of course, should you ever need support with either private equity professionals or, of course, portfolio executive hires, please do reach out to me at Raw Selection. But till the next time, keep smashing it. And thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.